was kind of bright and shining star out of that group. So they were a great fund and worked out really well for us. And we actually gave them an additional $100 million just this past May. So they continue to do a great job. And they're a firm that, you know, we probably wouldn't have stumbled across otherwise. So they were a good outcome from that program.
In other words, they're soaring high.
They are soaring high, yes they are.
The next manager is PERS. They're our large cap core growth manager. They've been with us. Since
August of 80.
He started managing money for us when I was 10 years old. Anyway,
Me too.
Beta Seraphim, their investment philosophy, they focus on large corporations with global earnings exposure that are able to demonstrate sustainable and predictable earnings growth patterns. This is a top-down approach. They do economic thinking, investing, and they rely on fundamental economic industry and company analysis to develop the portfolio. The portfolio substantially outperformed the S&P 500 by 728 basis points over the last 12 months. Outstanding performance. And outperformed in the volatile third quarter by 480 basis points. Strong stock selection in technology and overweight in defensive sectors such as consumer staples and energy. And a sizable underweight of financials with a principal value. Page 7 is a chart demonstrating quarter-by-quarter performance relative to the S&P 500 in up and down markets. And the red line shows the rolling 3-year performance numbers. Page 8 is a snapshot of what the portfolio looked like over the last 12 months in September of 2001. And the last manager is Intech, another large cap growth manager. This is it's a quant model. Intech strategy is based on a mathematical model that does not try to pick stocks or try to anticipate which stocks will outperform in any particular market. But they use stock price volatility and correlation characteristics to build the portfolio. Performance, 250 basis points above the index from the end of 2009 to June of 2011. What has improved, since the market, stabilized. Intech's investment process works pretty good in periods of less volatility, more stable markets. During the third quarter, relative market volatility increased by about 70%. The model, kind of suffered. As a result, the portfolio underperformed by 370 basis points and 228 basis points for the core.
This question, if you could you elaborate on? I know you may not have all the details of that model. I guess I can wait till they.
It's a model that's it's based around the index that they manage, which is the S&P 500 growth index. It's kept within very narrow bands around that index, and the model gives them buy or sell indications as stocks move around that index.
It's a very unusual process, and they will. It's based on volatility between stocks. So they're looking at how stocks move between each other over time, and rerun the model balance. So Bob Garden, so he will be a very good person to walk through, which I've had intended since we've got some new board members who haven't seen this process. It is totally based on mathematical calculation of volatility.
So it's not timing at all.
No, it's not, and it is not the easiest thing in the world to explain either. And the fact that they're not unlike a lot of quantitative managers who really had difficulty over the last few years, because things that are model driven, the models take data, over time, and the market's moving like this, and the data's coming in kind of one step behind. So they're constantly trying to catch up, and that's what's caused a lot of the problems. So I'm sure, especially looking at the performance over the last quarter, that there's been a lot of time talking about their model and when it works and what the expectations should be. So I apologize for not being able to give you the gory details, but it is a very long mathematical equation that drives their model.
Something else is not shown in these particular numbers here is that mega caps, outperformed in the last quarter, and they tend to the stocks they tend to focus on, that the model focuses on, is the lower cap or the larger cap, and those did not perform well as the larger corporations. Page 11 gives you a quarter by quarter breakdown of performance in up and down markets, and as you can see with the red line, as market volatility greatly increases, the portfolio does seem to lag. On page 12 gives you a snapshot of what the portfolio looked like since last time. Any questions?
From March 8th, 08 through June 10th, we have not placed them on a watch list.
They
Did
were.
we?
They were on.
Yes.
What we lifted it and we got up there? But we might have to get it again.
They will probably soon be back on watch. It's unrolling, it's based on rolling 3-year period, so they just kind of fallen down in the last quarter there, so they will be back, I'm sure. Unless volatility kind of smooths out in the market over the next 2 quarters.
Thank you very much.
Thank you.
Okay, so that's a preview of things to come after lunch as the managers get here, and I think we now have all of our talent crew here and represented, and I want to just kind of lay the groundwork for this. Again, we asked Callan to take a look at our international equity structure. We've got domestic equity, international, non-U.S. equity, and we've got global. So we wanted them to just take a really high-level look at the structure of our international portfolio. It's been a while since that's really been reviewed by our consultants, and kind of, again, see if we're on the right track, take a look at what we've got in place, see if there are things that we need to change or think about as we move forward. And it's really just kind of an annual checkup sort of thing, just to make sure that we're not missing something. Because as you all know, you get too close to things, and if you don't have that outside perspective, sometimes you just lose sight of the forest for the trees. So we're just here to make sure that we're on the right track. And so Jim Van Hewitt, who was here, I guess, a few meetings back, to talk about our asset allocation, policy at that time, has done the work on our international structure. So again, this is a very high-level look at the framework for our program, and then in December we'll come back with drilling down into the specific manager level. So again, I'm not asking for any action at this meeting. This is just an overview from a 10,000-foot.
Now, Jim, too, has been with Cal a little over 20 years. He's part of our strategic planning group, and that strategic planning group focuses on asset allocation, investment structure. And he also has sort of the institutional memory because he was involved when we were with you prior to our most recent convention, working in the asset allocation area. So, Jim?
Just to start off with kind of a brief executive summary, let me summarize by saying that I think your international structure is generally sound. You've done a good job putting it together, and it's very much like what we like to see in an international structure. Having said that, we do have a couple of suggestions that we might want to consider. One of which is that you have some regional mandates within the structure. We find that there are probably other things that you can do with those assets that might be more effective. And one of the other things that you might do with those assets is invest in managers that run against a broader market index. For example, the all-country world index, ex-US, have managers that run against that index might be a more effective use of those funds. So that's really the bottom line of what I'm going to get at today, and we'll go through the details in the course of the report. Are there any questions or observations before I start? If not, I'll dive right in. Just with the first slide is a reminder of what the structure is. As was mentioned earlier, we did the asset allocation in the spring, so we're talking about allocating assets between the large asset classes. Now, manager structure is allocating the assets within a given asset class, in this case, international equity. There are three really fundamental things that we like to get at within any structure, one of which is making sure that we structure the assets in a way that the asset class is fulfilling the role that it was designed for, in this case, equity. So equity is intended to pursue returns. We want to make sure that we're pursuing returns in every effective way that we can in the international portfolio. The second tenet is to make sure that the portfolio is fully diversified. So you want to be in all sectors, in all capitalizations. In the case of international equity, you want to be in all the countries that are liquid enough to take the assets that you have. And then finally, we think it's important to have some simplicity in the structure. We, in our experience, have learned that more complex structures are not necessarily better structures. They don't necessarily add any more value than adding more return. And they can be more costly and difficult to implement and difficult to understand, difficult to interpret when things are going poorly, what's going wrong or what's driving the structure. And we find that simplicity cuts through a lot of that as well as saving money. On slide 2, we get into the role of international equity, so we want to make sure that the structure serves these 5 bullet points. We're looking for long-term capital appreciation, so we're looking to pursue returns within international equity, and we're going to do that by having first a diversified exposure to international equity, recognizing that more than half of the world's capitalization is in non-U.S. based stocks. So we want to make sure that we are in that opportunity set completely. International equity also is an area where active managers have really consistently added meaningful value. As you may have seen sometimes in the large cap U.S. space, it's hard to find active managers that have as much value, let's say, as in the small cap area of U.S. equity. International, generally, and certainly more in some areas than in others, international active managers have tended to add value. The fourth reason is efficiency. You want to have the portfolio be fully diversified, and international equity provides a diversification role for the total portfolio, and we want to make sure that we're implementing it in a way that we're diversifying U.S. equity. And finally, liquidity. International equity is an area where you can pursue these returns that you need without having the money tied up as you would, let's say, in a real estate or a private equity investment. So we want to make sure that the international equity structure is liquid. Within that role, I mentioned that one of the key areas is the opportunity to add value. Adding value is especially important as you pursue your 8% actuarial expected rate of return. If you recall, when I was here last time to talk about the asset allocation, when we did the asset allocation work, we looked in terms of just a passive exposure or index exposure to all of these asset classes and didn't take into consideration the value that active management could add. And in the course of doing that, we found that your current asset allocation, we expected you to earn about 7.5%, so about half a percentage point below where you needed to be for the actuary. I think the actuary came back and said, made a good point that we would certainly agree with, and that when your expected return is below the actuarial discount rate, it's not that you won't earn the actuarial discount rate, you just have a somewhat lower probability of earning. So instead of 50% probability of earning the actuarial discount rate, I think we're about 45 or 46%. But we still want to make up that half a percentage point difference. We still want to make up those 50 basis points. Active management, especially international equity, is a good way to do it. And we can do that for several reasons. International equity, even in developed markets, tends to be somewhat less efficient than the U.S. equity market. Information does not transmit as quickly and as efficiently as it does in the United States. Certainly that's not as true for large cap international equity as it was. Large cap international equities is probably getting to be more like U.S. equities, so there are fewer opportunities there. But in small cap and emerging markets, those opportunities are still available. It also, I think one of the reasons that non-U.S. equity managers tend to be able to add value is that there are more levers for them to pull. In addition to large cap and small cap and growth and value, they can move between countries, they can move between currencies, they can move into developed or emerging markets if you give them latitude to do that. And so consequently, they have more flexibility and they have effectively used that flexibility they have. In addition to that, alluded to emerging markets. Emerging markets really have two benefits for the portfolio. One is what we call beta, so it's just the market movement. Even if you only had a passive exposure in emerging markets, we would think that they would be a valuable asset class because those economies are growing fast. Consequently, profitability in those economies is growing at a faster rate than they are in developed markets. In addition to that, as I mentioned before, because of the inefficiencies, which are primarily, I think, a function of a lack of investment coverage and investment research, it's not as deep in emerging markets as it is in developed markets, it's not as complete. They can add alpha, so that's value in addition to the returns that exist from investing in the benchmark itself. There are really two ways to get exposure to that. One way is the way that I mentioned in the introduction, and that's through the ACRI ex-US, or a global absent the United States mandate, where the manager not only invests in the emerging market stocks, but decides whether emerging market is highly valued relative to the developed markets, consequently, but underweight emerging markets, or is undervalued relative to developed markets, but overweight emerging markets. It has those two levers that they can pull. One of the issues with having a manager like that is because they are looking for both just a general emerging markets exposure. They want to maintain liquidity to move in and out of those markets. They sometimes don't invest as deeply into emerging market stocks, so they want to get into some of the smaller cap names. And consequently, it's useful to have managers that are solely dedicated to emerging markets that know they're going to be in there and can spend the time to research those smaller cap stocks and invest in them knowing that they won't have to liquidate because now developed markets don't like that. I've mentioned a lot of the advantages of the different aspects that international managers can use to add value. There are certainly clearly disadvantages to them. One of which is that, you give them enough rope to hang themselves sometimes. I mean, you can make wrong decisions, you can make wrong moves, and that can lead to underperformance relative to the index by active managers. And sometimes that underperformance can be persistent for some time. In addition to that, the more managers you have, especially the more active managers you have, the more fees you pay, the more oversight you have to have. So there are administrative burdens to expanding the opportunities. And also in terms of adding value, I wanted to make some specific reference to your overall index, which I do on slide 5, and that's the Equity XUS IMI index. So all country world index without the United States, and that's an investable market index, is the IMI. And that index moves more deeply into these markets. It has smaller cap issues in it, which provides more opportunities for your managers to pursue. If we were just looking at an EVA index, just a developed markets index, remember those opportunities would be limited because we're talking about large and mid-cap stocks. If we were looking at just the Equity XUS index, we would add emerging markets to that, but we wouldn't have the smaller cap stocks in their diversity. So having that index really is conducive to employing active managers. Remember that I said that the neutral position is neutral to emerging markets versus developed markets, and small cap versus large cap. What we found in a number of instances with our clients, and we think that this can be justified, is overweighting small cap and overweighting emerging markets exposure to earn extra returns. Now, the flip side of that is that returns are compensation for taking on additional risk. So the way I think to make that decision is to say, can we accept the additional volatility of more emerging markets, of more small cap, in pursuit of this longer term return advantage that we're taking. So that's kind of an overview of the structure thoughts that we have going into this presentation. I wondered if there were any questions or comments. If not, on slide 6, we talked about, remember I mentioned before that active management adds value. I'm going to look at 3 slides here that look at different segments of international equity, the first being the developed markets, and then we'll look at small cap, and then we'll look at emerging markets. And what we're looking at in this graph here is rolling 12-quarter periods, so rolling 3-year returns at the dates ended on the horizontal axis here. So you see we start, first 3-year period ends in the middle of 2001, and we'll go through the second quarter of this year. The line at the vertical axis here is measuring excess return. So return in this case over the EFA index, because we're looking at active core managers, which generally have an EFA benchmark. And so that flat line at 0 would be if you just invested in the EFA index, you're not going to over or underperform the EFA index, you're going to have a flat line at 0. The gray area is the range of active managers that we look at. We have a large number of them in our database. And the bottom blue line, the blue line at the bottom of the gray area, is the bottom 10th percentile, the worst performing active managers. Conversely, the blue line at the top is the top performing 10th percentile of managers. And so the gray in between is that whole range, with the middle line being the median manager. And so looking at the median manager is representative of what you might get from an active manager with an EFA benchmark. We find that on average over the last 10 years, they've added about 76 basis points worth of extra returns. That's gross of fees. So net of fees, they're just marginally ahead. But they seem to, that the blue line or the blue median line is generally above the EFA line, the 0 line. So they have tended on average to add some value. But again, because they're in bulk markets and because they're in very large mid-cap stocks, which are fairly efficient, it's a little bit challenging for them to add to that.
And I think a reasonable fee, well, actually, I don't know exactly what the fees are for your current managers, but I think around 40 basis points would be the ballpark here. So just a little bit,
according to what happens when we have this kind of piece. So if not, still worthwhile. On slide 7, as I mentioned before, we'll go into small cap managers. Have had a shorter, first of all, shorter track record. The large cap track record actually goes back further than what we showed before, but some of that track record may not be relevant. Here we have all the relevant track record for small cap managers, which is really only about 8 years. And you see two distinct periods here. In the early periods, you see the median is underperforming the EPA small cap index, and subsequent to that, beginning of 2006, we see the active managers beginning to outperform. And I think that this is well, first of all, on average, they had about 84 basis points over this relatively short time period. So net of fees, they are adding some value. But I think that the first period speaks to what I said before, is that if you decide, as you have decided to have dedicated exposure to small cap managers, that you have to understand that there are going to be 2 or 3 year periods where they will underperform the passive index. And hopefully subsequent to any future performance, we'll have the kind of performance we had in 2006 going forward. Will make up for that deficit. And certainly, just as with small cap U.S. equity, there's going to be more volatility.
And just a reminder, committee, we did add Mondrian and Paramus earlier this year as two of our newer managers in this, and they are actually in small cap non-U.S. space.
And then finally, in terms of active manager performance, we looked at emerging markets. We have a relatively long track record with them, and it generally seems relevant. So we included most of that. And you can see that, not surprisingly, because of the informational difficulties and the opportunity to really dig down into some of the small cap managers, and that they've exploited that and have added almost 1.75% over the index for this entire time period, almost 17 years. So a lot of value added, we believe, in the emerging market space. With that, if there are no other questions, I'll start specifically with the PERS structure. On slide 9, excuse me. At the top of the page, we have EPA exposure. First passively through BlackRock. We think that's a good idea because, as I mentioned before, the opportunity for active managers to add value is somewhat limited in this area. And so having a passive core, we think, is a good way to get that data, that market exposure at a low fee. But because there is some opportunity for active manager value added in this area, you do have 3 active managers that can be diversified in style. And we think that's a good idea. Mentioned earlier now, as we move down below the broad EPA exposures, the 2 regional exposures here, one to Pacific and one to Europe. And as I say, we don't think that this is a terrible idea, but we don't think it's the most effective use of the money. The reason is specifically that with your structure, now you've got 5 active managers in an area of the international markets that tends to be efficient. And so probably over-allocated to that active management by virtue of the fact that they are limited in the regions in which they can invest. We've taken away some of the opportunities to move between less attractive regions and more attractive regions. And it's also difficult when you have regional managers to diversify stock. You can try and pursue Pacific managers or European managers that are core in stock, but usually they have some bias either to growth or value. You can try to get around that by having a growth manager and a value manager in Europe, but now we've added even more active managers in an area that is difficult to add that. Consequently, as I say, while regional managers are, it's not a bad idea. It can be challenging to implement, and challenging to add value in there, and certainly we think that the money might be more efficiently put into that equity ex-US unit. As Lori mentioned before, as we move down to the next section, you do have active small cap managers in the core in nature, and we like both of those managers, and we think that that's a good allocation. And then finally, you have active managers in